Investability, and Colony American Finance at the end of the program. And with that, I'm going to turn it over to Dennis and Stephanie.
Great. Thanks so much, Barbara. Really appreciate it. And I appreciate everyone that's listening today. Both Stephanie and I hope to bring you some insightful information into what's going on in this very exciting asset class. And so with that, I'm going to get started on covering a little bit about how this industry has evolved from its early stages. And so the first thing I want to go over is really three major items that have impacted this sector overall. And for those of you that might be new to investing in single-family real estate, excuse me, let me get the right slide there. There we go. For those of you that might be new to investing in single-family real estate, it is a explosive asset class right now. There are nearly 16 million single-family rental homes in the U.S. today. And that number has gone up pretty dramatically over the last few years. And so I'm going to cover three main things here that have really impacted that growth. And we're going to start with social and demographic conditions. We're going to talk about some of the economic changes that have taken place. And then also what the advent of the institutional investor in this space really means for the everyday investor in the asset class overall. And that's really the Wall Street investors is what we're going to be talking about. So starting with the social and demographic part of this, as you may know, after the recession, millions and millions of houses were foreclosed upon, but yet people still needed a place to live. So what has happened over the last decade is we've created this environment that is creating an ability for there to be sustained growth within single-family rentership. And that means that ultimately the housing market and the home ownership rate in this country will continue to decline. So to give you guys a little perspective, the home ownership rate in the U.S. at its peak was almost 70% in 2004. Today it's only 63%. And that's in the face of a continued growing population. So in 2004, there were 112 million households in the country. 70% of them own homes. That means there's roughly 78.5 million homeowners, leaving 33.5 million renters. Well, today in 2016, we've added 14 million new households in the U.S. since that time. So we're up to 126 million households, but now only 63% own homes. So there's only 79.5 million homeowners today. Even though we've added 14 million households, we've only added 1 million new homeowners. And so what that means is all of that demand has been pushed into rental properties. So if you're an investor in single-family rentals and you're wondering, why does the rent that I'm able to charge keep going up? Why are people not leaving my houses? It's because there's not an available amount of supply to satisfy these folks, and it's not keeping up with the demand of the household growth. And the reason that the demand isn't there is a number of different factors that are both economic and demographic. Anyone that's listening, if you guys have actually tried to get a mortgage before, you know it's brain damage. It is more heavily regulated now than it has ever been, even though interest rates are near an all-time low. So the fact that these credit standards are tough for most people makes it more challenging to get into a house that they might even be able to afford, but because of the underwriting standards, they can't get approved for the loans they need, or they may not have enough down payment to get approved for a certain type of loan. There are several reasons behind why some of these folks are not qualifying. Number one is, as you've probably heard, the amount of student debt that's outstanding in this country is at an all-time high. More and more potential home buyers are saddled with egregious amounts of student loan debt that eat into their personal savings rate. And not surprisingly, the personal savings rate in this country is going down. I would be amazed if you told me, 7 years after the Great Recession that people wouldn't learn how to save a buck. But it's not that they don't know how to save, it's that they have to attribute their dollars to other things like student loan debt, like increased cost of rent. So you have those factors starting to suppress people's ability to actually buy a house, but it doesn't suppress their ability to need housing, and that's why you're starting to see rent prices continue to increase and vacancy to continue to decline in almost every major metro area across the country. When you factor in that we're not building enough homes to keep up with this household growth, it only exacerbates that supply and demand imbalance. And this might be a little surprising to you guys, but in 2016, in the United States, we built the same number of houses of new home construction that we built in 1961 when JFK was president. There's a big difference between now and 56 years ago. The population of the United States right now is 350 million people. The population of the United States then was only 200 million people. So we're adding supply at a rate that does not add up with the current amount of demand and overall populace that we have to support. And the end result is you are going to continue to see the homeownership rate in this country decline. You're going to continue to see upward pressure on rental prices and home prices, and you're going to continue to see a decline in vacancy. Now, that is an awesome, awesome combo if you're an investor. It's a little depressing if you're a believer in the American dream of homeownership, but these are the conditions that we're faced with right now from a demographic and economic perspective. But if you're looking to take advantage of this, if you have extra capital, if you have money sitting in your self-directed IRA, these are things to take note of because you're in a very ripe market to take advantage of some of these conditions right now. And I'm not saying this because this is what my company does or this is what Colony American Finance does. I started my career as a housing market analyst and an economist. I've studied it my whole life. I've never seen a combination of different factors that are supporting a consistent decline in homeownership over the next several years, which again benefits you guys as investors. So with that, the other thing to take note of is what is really starting to change this asset class is the entry of the institutional investors. And that is the Wall Street guys that you have been reading about in the paper or online. There has been a lot of noise about Wall Street coming in and buying houses on Main Street. And while that's true, it's not nearly as impactful as you think it may be, at least in terms of changing actual market conditions like pricing and supply and everything else. If anything, it's actually benefited the small investor by the Wall Street investors coming into play because they have helped mature this asset class. Single-family rentals aren't a new thing in the U.S. economy. There have been at least 10 million rentals in the U.S. since the 1970s. What's different is there was never an availability of services, of financing. There was never any kind of real scale behind it because this is a very fragmented industry. Of the 16 million single-family houses that are out there, those 16 million properties are owned by 10 million different companies and individuals. So it's very spread out. A lot of people own just one or two properties. And the issue with this is because most of the investors are smaller in nature, there have not been a great amount of financing options available. There have not been a lot of services and technology behind this. But as soon as the Wall Street investors came in, they really changed the game and they leveraged a lot of what has already been going on in the multifamily sector, that is apartments, to bring up everything to speed here. If these Wall Street groups were going to be investing billions of dollars, they needed to have the availability of good financing. They needed to have the availability of automated services. And that's some of what I'm going to talk about next is really what are four of the main ways that technology have helped push this along. But the big Wall Street guys, for all of the press that they've gotten, you'll see right here on this next slide, they only own 200,000 houses between them. And I know that is a big number for sure, but it's not that big of a number of the 15 or 16 million single-family rental properties that are in the market today. So these groups have had a incredible impact for the everyday investor. There's online property tools, software, big data, all kinds of stuff I'm about to talk about that didn't exist until people had to service the handful of institutional investors in this space. But overall, they make up a very small percentage of it. And so, sometimes when you compare Main Street versus Wall Street, you think it's David versus Goliath. But I will tell you here today that Goliath in this scenario is the individual mom and pop investors on a collective basis. They're the ones that can really move the needle for the overall housing market in this sector. So the next thing I want to share with you guys is really what some of the new developments in the SFR sector are and how they can benefit you, as an investor or someone looking to get into this market. So the first thing I want to talk about is big data. Nearly every industry has benefited from the advent of big data, but what does that really mean for us as real estate investors? From a practical standpoint, it's really a combination of two things. The data sets we deal with have grown larger and larger as we track more data over time. And our computing power and access to cloud storage has sped up the processing of that information. So when you combine those factors, we're now able to analyze higher volumes of data faster. And as a result, real estate data companies like RentRange Data Services can now deliver more insightful information to the investment community at a faster clip, allowing investors to make better decisions. So we're getting to this point now where we have this ability to continually access and analyze an abundance of information that just frankly wasn't available before. For any of the investors that have been in the sector for a long period of time, this part of our asset class has grown light years. And the next step now is really advanced machine learning, where we're able to differentiate the signals from the noise. And that is, we're figuring out what variables are truly important to help predict real estate investment outcomes. And this is all about us analyzing risk and making better decisions. When it comes to online automated solutions, anyone that's a landlord out there knows that the biggest constraint is on your time and the day-to-day management of an investment property, whether it's leasing vacant properties in the dead of winter or getting a call from a tenant at 3 a.m. to repair a broken water pipe. One of the most onerous parts of being a landlord is the burden it puts on your schedule. So the good news is there's a slew of automated solutions that are coming online that can make your life easier. A good example of that is a company called Cozy. It's an online property management portal where you can have your rent paid automatically. You can get your tenant set up with automated payments. You can get background checks done. There are new companies coming online that take complete control of repairs and maintenance on properties, and they use an Uber-like functionality that when the tenant reports an issue, you get notified, a local service professional gets notified, and you're able to respond efficiently and not have to worry about that labor yourself. Two other things I want to talk about briefly are the advent of virtual reality. So if you look historically at the way that investors work and the way that they buy properties, 70% of the time an investor buys an investment property within a 10-mile radius of their own backyard. Now, a big reason for that is investment 101, invest in what you know and what you understand. People understand their own backyards better than anywhere else. But as big data has continued to evolve, we've been able to process and give people more information about being able to invest outside of their own backyard. There's still an issue, though. As people, we have a biological need to trust what our eyes tell us. And so the rapid evolution of virtual reality is making it easier to get somewhere that you've never been before. So whether you're doing something like walking through a neighborhood using Google Street View, or actually being able to virtually walk inside of a house using a technology like Planomatic, you're now able to virtually wander around neighborhoods and even see inside properties before, giving you that ability to understand the sniff test of whether a property or neighborhood might fit your investment objectives. The last thing I want to cover is building materials, and this probably doesn't look like it fits with the other three at all, but, This doesn't look like it fits with the other three at all, but when you think of building materials and technology, they don't go hand in hand, but scientists are actually really trying to make more efficient, longer-lasting materials that ultimately are going to reduce your annual operating costs, your maintenance costs, your deferred maintenance costs, your capital expenditures that can ultimately improve your bottom line. And so I just want to highlight one for you guys today that I think is really cool, and that is self-healing concrete. And if you haven't heard of this before, I know the concept sounds straight out of a science fiction movie, but a microbiologist out of Europe has developed a self-healing solution for what is ultimately the world's most popular building material. So all concrete eventually cracks, but this scientist has blended the physical with the biological, where he mixes regular concrete with a type of bacteria that which serves as a healing agent, so that when there is a crack in the concrete and moisture is let in, the bacteria becomes active, and when the cracks eventually form, the water enters into any crack. It activates the bacteria capsules. They feed on a compound that they're mixed into the concrete with. That produces limestone, which eventually fills in the cracks. Pretty amazing stuff if you think about it. And once this product comes to market, you can rest assured that it'll be a long time before you have to patch up your driveway again. So those are 4 ways that new tech developments have really helped evolve this space. What Stephanie's going to talk about in just a second is how another part of this industry has evolved dramatically, and that's the capital markets and how financing has evolved to put the average investor in a much better position than they were today. Our platform in Investability, if you haven't been there before, it's pretty simple. And I will say this at every seminar I give and every speech I will be on stage for. We try to do 3 things for the investment community. We want to give you access to information, we want to give you access to properties, and we want to give you access to resources and services. So our goal in Investability is really to become a one-stop shop for the average investor, where they can have very powerful data at their fingertips. We started a data company, and our biggest customers were Wall Street investors, and we've kind of flipped that model on its head and started to give that information away to the average investor to try to empower them to make better investment decisions. Investability has a Zillow-like functionality where you can search on over 1 million properties in the U.S., including a bunch of exclusive listings that you can't find anywhere else. And even better, we use our proprietary data to help you understand what the investment potential for each of those properties are. And when you're finally ready to pull the trigger, we have relationships as well as a bunch of other included services. So whether you need title, insurance, property management, construction services, or even financing with a group like Colony American Finance, you can find that all at investability.com. So I would encourage all of you guys to go to the site, check out what our offering is. As I said, when you're looking between RentRange, which really drives all of our data, you have the ability to look at and assess properties all throughout the country, so you can understand that if there aren't a lot of investment opportunities in your own backyard, you can find them elsewhere. I've lived in California my whole life. It is hard to find an investment property that pencils in Southern California right now. So when my friends come to me and ask for advice, I send them to Investability and I say, look in the Midwest. Look at what the cash flows in Ohio and Texas and Illinois look like right now, and realize that you can have all of these services included with the purchase you're doing to kind of make this as passive of an investment as you want to be. And you can use some of the services or all of the services. It's entirely up to you as an investor. With that, I want to turn it over to Stephanie to talk a little bit more about how the financing in this sector has evolved and really how finance and technology have come together to provide a better experience for the average investor.
Thanks, Dennis. As Dennis said so eloquently, not only has the evolution of technology meaningfully impacted property investing, but so too has the evolution of the financing options available to investors. There really are 5 main sources of capital for single-family investors as well as kind of all asset class investors. The 3 most traditional forms have been, friends and family, your local bank, or your own savings account and cash. Each of those comes with their own sets of pros and cons. And then with the evolution of other financing options, we've seen the emergence of marketplace lenders, and then the specialty or private lenders. Some of the challenges with marketplace lenders is that, yes, the pros are the process is very streamlined and it's online based, but there tends to be some question about the availability of funds and questions around reliability. I think there are some great marketplace lenders out there that have really put those questions to bed, but they do still exist. From a specialty lender and private lender perspective, Colony American Finance really falls into that space, and those lenders have emerged, much like CAF has, because they understand their prospective customer and the space in which they operate, and have custom tailored their lending products or financing products to meet the needs of those customers. So in the case of Colony, we've purchased thousands of homes and understand that process and what the needs are of the guys and girls, I should say, in the space who are in fact buying. So to continue, I am going to talk us through, if I can get my slide to advance. There we go. I'm going to talk us through a few illustrations of really how leverage can increase returns for both fix and flippers as well as for rentals. Jumped the gun there, went a little fast. So this first illustration is going to really kind of walk you through how using leverage can increase your cash-on-cash return in just a flipping scenario. So on the left-hand side of your screen, you'll see that we have this kind of all-cash $100,000 example where you're going to purchase a property for $100,000. You're going to use all cash to do so, and you'll flip it in some period of time at a profit of $25,000. Well, that analysis, as you can see, is effectively a 25% cash-on-cash return. Not a bad day. I think we all are looking for more than what our typical bank savings account is earning on our money today. But with leverage on the right-hand side of the screen, you can see that we can use 75% leverage and purchase that same $100,000 property by only using $25,000 of our own cash and $75,000 in debt. We still have the same execution when it comes to the flip at the $125,000 price point with a gross profit of $25,000. However, our net profit, because we have to take out the interest that we paid, let's say, for a year, is going to be $17,500. Keep in mind that return analysis is only based on the $25,000 in cash you put out. Somebody else's money you already paid for in that 10% interest. What this leverage example illustrates is a 70% cash-on-cash return, and I think it's tough to argue that this is not compelling. Debt is very, very helpful for a real estate investor, understanding the caveats of using debt to an extreme or becoming over-levered, and recognizing that it certainly comes with some meaningful risk. But in a measured way, debt certainly helps with your returns. Beyond just increasing your cash-on-cash return, that same $100,000 that you would have used in an individual purchase can actually be turned into 4 properties instead of just one, because you're using debt. And so instead of buying one property for $100,000, your $100,000 can then be spread across 4 properties, further increasing not only your portfolio but also your returns, because you're able to sort of expand faster and generate more in terms of yield. Another way that leverage can be used to sort of increase your returns is less about adding more volume to your portfolio, but rather moving up the value spectrum in terms of the properties you're looking to acquire, renovate, and flip. This example you see here is, not a $100,000 purchase. However, it's a real life example of a CAF borrower that has used leverage through our credit lines to start buying much larger, higher valued homes. This is a 5-bedroom home in Southern California. You can see some of the before and afters. And they were able to buy in and leverage this asset using their line put in some meaningful renovation work, and they sold it for over $3 million. This is pretty compelling, and something that, you know, they started out as a borrower with us that was kind of our entry-level credit lines, buying $150,000 properties. They are now a large customer of ours, buying beautiful homes like you see illustrated here. Finally, by allowing your equity to go further, so that $100,000 in cash that we're talking about, this $100,000 in cash we're talking about, by using leverage, you're going to let that equity go further, building on your rental portfolio. So rather than owning one rental property that you purchased for $100,000 that has a net rental income of $10,000 a year, you could expand your held portfolio to more than one property, in this example 4, and your net rental income annually is more than doubled. So this is just one further illustration, not just for flipping, that debt is certainly helpful, but also for aggregating into rental portfolios and growing that base of income for you. Colony American Finance offers 3 different products, loan products, to meet the needs of our single-family home investors. We have a bridge line of credit, which is the business that I'm responsible for, anywhere from $1 million credit commitment on up the spectrum, and it really meets the needs of smaller borrowers who maybe still have a day job but are flipping some assets on the side, all the way up to vertically integrated institutional large real estate companies. It can be used for acquisition financing as well as stabilization of rental portfolios before refinancing those assets into some sort of longer term product. Speaking of longer term products, Colony also offers 2 term loan products. One is a portfolio term loan, which is for 5 units or more, as well as a single asset 30-year fixed individual rental property loan product. And so because we understand and have been in this space for quite some time within the SFR investment space, we have developed these products to sort of address all the needs of our borrowers, anyone that starts out small and can grow with us. We even have borrowers that have started out as just flippers, but then see opportunity to generate higher yields by holding as rentals and are able to then refinance into one of our other products. It's great because we are a one-stop shop for those borrowers or those customers, where it's pretty easy to sort of work through the process with us if you're already kind of underneath our wings, so to speak. So I encourage you to sort of go to our site and explore and reach out to us and ask questions. And I know we'll have some opportunity for that shortly, right here on this call. To obtain financing with us, it's pretty straightforward. 4 simple steps. I'm sure you're all familiar with it. It's providing us with the property information and your track record and what you're targeting to buy. It's submitting an application to get quoted from our team of originators. And then you go through the standard underwriting and diligence process with any of our product offerings to ultimately get to the closing point where you can then, make your equity dollars go further by using our debt products. So ultimately making more in terms of return using less of your own dollars.
Great. So next, let's jump into some questions for Stephanie. Stephanie, Greg wants to know, on the single asset rental loan, does the property need to be rented or can it be rent ready?
It can be rent ready with a signed lease in place, even if the tenant is not already moved in. The expectation is that the underwriting, I guess I should say, is based on the cash flowing ability of the property. So I think, and bear with me because I'm not the expert on our single asset loans, but there's a lot of flexibility offered with respect to rent-ready properties that will be tenanted within a short period of time.
Okay, great. Next question, again for Stephanie. David is wondering if you provide non-recourse loans for 2 to 4 unit properties.
We do. We offer full and non-recourse loans across all of our product types. Our credit lines, as well as our portfolio and single asset term loans. There are, of course, the customary carve-outs on the non-recourse for bad acts, so to speak, but those opportunities are definitely available to you across all of our product types.
Okay, great. So switching back to Dennis, Stuart is wondering if we offer heat maps that are up to date and include pricing.
Yeah, so our sister company, RentRange, has a lot of data services available for the average investor. So we have property level reports that will give you larger information about the surrounding geography, whether that's a zip code, a county, a metro area. Heat maps are something we totally can do, whether you want it to be pricing or vacancy, it can be by bedroom count. Any of those are definitely solutions that we have that are digestible for big and small investors. It's just a function of just going to rentrange.com and contacting our sales team, and we're happy to help you out.
Okay. So Stephanie, we've got a question about when Colony American Finance funds a rental portfolio, are you looking at the property or at the investor?
We're looking at both. So of course, we're going to look at the credit and background and track record of the borrower, the actual investor, and we're going to be taking a look at the in-place income and NOI that that rental portfolio is going to be throwing off, because that's a key component in understanding the ability to cover the debt service on that portfolio or on that loan. So it's both.
Great. So it sounds really like interested borrowers would just reach out to you to learn more about their specific circumstances.
That's exactly right. And I think what everybody should take away is that there's always going to be something that is an exception, right? And we're in the business of making loans. I want to do business. I want to put out money. I want to originate more deals. And so if there's something that doesn't fit the exact box that you see in terms of our guidelines and parameters via our website, et cetera, it's still worth making the call, talking through the process, talking through the situation, because we want to try to facilitate the growth of our customers. And if we can get comfortable and come up with a solution, we're going to do what we can to find that solution so that we can work around something that might be outside of our typical box.
Great. Okay, so interesting question just came in for Dennis, wondering whether there's a software that you recommend to manage and keep track of acquisitions. Example, if you're buying a lot of REOs, how would you manage and keep track of them?
Well, it really depends on what solution you're looking for. So keeping track of something during the acquisition process is a lot different than keeping track of something as an asset manager. So there are good solutions out there, and it depends on your volume as well. I'm a little bit old school. I'm just old, period, but I'm also a little bit old school. So, a lot of my stuff I will build in Excel to begin with, and then once I get to a large enough of a portfolio, then I'll start to transition to other online solutions or other software services. Now, that's just the way it works. I've been an analyst and an investment banker for a long time, so Excel's my best friend. I personally think that groups like Appfolio and Yardi are really cool, and they are starting to make more kind of trimmed down versions of their solutions for the smaller investors. So I believe Yardi's come out with something called Rent Cafe recently that works pretty well for the smaller investor. And you're able to really track not only your acquisition performance, but also the performance of those properties going forward.
Okay, fantastic. So, Stephanie, Tom is wondering, he says he currently has a portfolio loan with Colony American Finance and the values of the properties have gone up. Can he use equity to secure a new line of credit?
Equity that he has in the existing assets that are already financed with us? Is that the question?
Yeah, that's what
okay.
Exactly.
Yeah. You know, we definitely take into consideration the net worth of our borrowers or our prospective customers for our lines of credit. So in that case, that value appreciation that he's experienced on his portfolio term loan is all going to go towards that net worth number, right? So that numerator is going to be greater with a static denominator with respect to the debt on those assets. So it definitely could be used as one of the factors that goes into qualifying for our credit lines. Look, we need our credit line borrowers to have a little bit of cash available because we aren't 100% financing on their acquisitions. And so you need to be able to bring some equity to the table to close on your new acquisitions, as well as some cash to potentially, do whatever renovation work needs to be done as you go through the stabilization process. But certainly, appreciation and value on a term loan product will speak to, increased net worth in that case. So it certainly could be used as a credit enhancement, if you will, in the underwrite to qualify for a credit line with us.
Okay, great.
Yeah. Call me.
So,
or your originator that you've worked with before.
And that's a great point. We've had so many really great questions come in, many of which are specific to these individuals' unique circumstances, and so
right.
The call me is great advice because a lot of this will be discussed in a one-off type scenario. So
that's right.
I'm looking at our timer here. We want to be respectful of everybody's time and know that you all have jobs to do today as well. So let's run through a couple more questions, and then I'm going to ask Stephanie and Dennis to offer any closing remarks or final words of wisdom to send you off on the rest of your day, and then we will wrap this up. So Dennis, Kevin is wondering how Investability assists with locating good properties nationally. Specifically, what source of data should he be looking at to indicate which markets are a good fit for his investment objectives?
That's a great question. Unfortunately, I don't know Kevin or what his investment objectives are. So it's hard to point him in one particular market, but I will tell you what I always look for is stability and growth in a market. I don't look for a place that's overheated because of one particular job sector or one particular industry. I'm looking for good long-term sustainable growth, a diverse economy, hopefully some undersupplied conditions when it comes to a market like that. So, a couple places that come to mind that fit the bill right now, Dallas, San Antonio, Chicago, Miami, those are all markets that also have somewhat lower barriers to entry when it comes to a price point. If you're going to go try to invest in San Francisco or New York, I hope you have a lot of free cash or a very big line from investing. Because it's going to be
right.
expensive. So when you look at markets like that, there are places where not only do they have great in-migration from other places, meaning people are moving there, but they also have natural household growth. The population is expanding, job growth is expanding. They're not relying on one particular industry. You see rents going up in the right direction. You don't see a ton of new supply coming on relative to that household growth, and that is really what's going to kind of push good long-term demand. So, Kevin, if you went on to Investability, what you can do right now is kind of search anywhere in the country you want and start to see what the return thresholds look like for properties that are either on the market or that we are selling on an exclusive basis. If you want to take it a step further, we have account executives that really start to understand your objective needs, your investment objective needs, and then start to create a real plan around what you're trying to accomplish. We had a guy that we met at a conference recently that had never heard of Investability. I'm sure there's some people on this call that hadn't either. He was able to talk with our account representatives, our brokerage team, and this is a guy that lives in the Bay Area, didn't know where to go. We were able to help him acquire 3 properties in Texas within a matter of weeks that were right in his buy box, what he was looking to accomplish, and away he goes. And the next thing we did for him was we hooked him up with a property manager. We hooked him up with a construction services guy. Excuse me. And then right now they're in discussions with Colony American Finance for the financing. So that's really what we're trying to bring to the table, is to make this a simplistic one-stop shop where we have all the resources you need. And we are housing market experts, so we feel like we can give you good advice. We're not, one of the things I think really separates us from a lot of other groups out there, there's a million properties out there. I don't care which one you buy as long as it's right for you. So what we're trying to do is help give you the information and resources to make the decision that's best for you. I'm not trying to cram, you know, some random property in Toledo, Ohio down your throat because that's what I have to sell. I'm trying to give you guys information and resources so that you can be better investors, because the better investor you are, the more you're going to buy and the more business we're going to do together.
Right, great. And so one more question for you, Stephanie, and then we will start to wrap things up here. So we had a question come in over email from a listener who says that he owns several rentals free and clear. They were bought at different times. So he's wondering whether he can use a portfolio loan from Colony American Finance to liquidate those properties, and if so, if there's a minimum length of time that they need to have demonstrated proven income.
Yeah, so absolutely, he could refinance some of his equity out of those properties via a portfolio term loan. Typically, we have some constraints related to max LTV as well as debt service coverage, right, that would dictate how high up the cost spectrum we would be able to go with respect to the loan that he would be getting. So what the final proceeds would be contingent on a number of pieces through the underwrite. I think, you know, having the portfolio needs to be leased, materially leased. Oftentimes we'll see stuff that's 90% leased when it comes in, et cetera. That's fine. We understand and want to work through with the borrower whatever that story is so that we get comfortable, and then the proceeds from that loan, that cash out refi, if you will be sort of predicated on all of those moving pieces and sort of how they come together in total. So again, as I said earlier, I would certainly recommend, you know, reaching out, getting us the information on that portfolio and exploring kind of what type of loan we could get you in terms of total proceeds so that you could use that equity to go build more of your portfolio.
Okay, great. All right, guys, we are running out of time. Right now, I'll turn it back to Dennis and Stephanie for any, you know, closing thoughts or remarks, anything you want to leave these listeners with before we disconnect today.
Well, I'll defer to Stephanie. Ladies can go first.
Oh, good. Thanks, Dennis. Appreciate that. Look, I think, you know, the evolution in real estate investing in general, especially with the really institutionalizing of the single family investor, has made a huge impact in a number of areas, and we've talked about them today. Dennis went through how the technology improvements are making it easier to find properties that fit in your box, service them, manage them, et cetera. And a natural outcropping of that would be the financing evolution. And I think we're going to continue to see it evolve. And because you have SFR experts that are sort of running these businesses, like Dennis, like the folks here at Colony, we're going to understand the investor's needs and be able to try to craft a solution, whether it's from a lending perspective or some other technology perspective, to support your business needs. And I think that should be kind of the bottom line takeaway. Just because something doesn't sound like it's going to work doesn't mean it won't. So have those conversations with us or with Investability and grow your portfolios.
Am I handing off
now? Dennis, anything?
So you're up, Dennis.
Okay, fair enough. Look, I think this really comes down to information, and that's where power is right now for the average investor. Because this industry has been fragmented for so long, people have just always kind of done things their own way, not knowing what the rest of the market does. And that's starting to change now, and it's because of groups like Investability and Colony and a lot of other very strong players out there that we're really trying to defragment this market, for lack of a better term. We have, 150 people on this webinar. There are another, 10 million people to go after to help make sure they understand the resources and tools available at their disposal to become better investors. And that's what it comes down to is, maybe we don't have 10 million investors out there. Maybe we now only have 8, but those 8 million investors are smarter, better prepared, better equipped to become better landlords, get better returns, and really view this as a very viable alternative asset class to just putting your money in the stock market or in a 401k and having a little bit more control over your own destiny. And so when you realize that information is available, those resources are available, whether it's data, whether it's understanding markets outside of your backyard, or even understanding the way financing has evolved. Stephanie has done a great job of explaining how this market has evolved, but I am telling you guys, 5 years ago, if you wanted to get a financing on a single-family investment property, you were going to a hard money lender and paying 14% with 3 points. You were hoping you could convince your local bank to do it, which was pretty much always a no. Or you getting a loan from Fannie or Freddie that was based on your personal income. So unless you were a doctor or an actor or a CEO, you could never get more than one property. So the fact that this has all evolved to really become what I consider to be the easiest time to invest in single-family real estate, I think people are fooled if they're not taking advantage of the resources and information out there now. So I would say just continue to do your homework, use resources like our firms to help you become better, smarter, better equipped investors, and happy hunting out there.
Okay, so with that, guys, thank you so much for attending today. As I made mention of before, we've had so many great questions come in. We weren't able to get through them all. We will be going through these and follow up via email after this airing. Again, the recording will be made available to all attendees following the program, so keep an eye on your inboxes for links to those assets. And, we just appreciate your time today. So please, you see contact information and websites up on your screen. Visit Investability, visit Colony American Finance for more information. Certainly, you can email my team at marketing@investability.com with specific questions. And please keep an eye on those inboxes. We will follow up shortly and look forward to bringing you more great webinars in 2017. Thanks so much. Have a great day.
Thanks. See you guys.
Thanks. Bye.